Despite their track record of strong earnings reports, if you do a Google News search of Decibel Cannabis, you'll find very little coverage. You'll see a few headline-only articles, and you'll see that Haywood Capital and Raymond James both have positive things to say about Decibel. But the only other apparent analysis of them comes from a site called Simply Wall Street, which I'm not very familiar with. They may otherwise do some good work, I don't know, but they made some mistakes in this case. They claim that Decibel actually lost $4.5 million last year, but how do they get to that? Well, they take into consideration the change in fair value of inventory sold. But that only comes from them selling inventory for less than they hoped to. It doesn't mean that they sold it for a loss at all. Say you had inventory that you claimed you were going to sell for $100 million, but you ended up only selling for $80 million. However, your all-in costs, both production and operating, were only $50 million. Did you lose $20 million or did you make $30 million? Obviously, you made $30 million, which is why those lines, change in fair value of inventory, don't matter whatsoever. By any other cash flow metric, Decibel absolutely made money. Take their net revenue, subtract cost of goods sold, subtract selling, general, and administrative, subtract financing costs even, and you're left with a profit of over $9 million. Further subtract depreciation, and they made $5.5 million. That may not sound like very much, but it's not bad for a company valued at a little over $50 million. Especially when you consider that their cash flow is accelerating rapidly. They began the year with a little over 3% market share and ended it with 6.6%, and have increased it further from there. Simply Wall Street also mentions that Decibel has more current liabilities than they have cash and accounts receivable, and they imply that they're at a high risk of dilution. While it's true that they do have more debt than cash, despite what Simply Wall Street claims, they are making enough money to change that fairly quickly. In fact, last year they bought back their convertible debentures, which carried the highest interest rate and the risk of dilution. And early last year, they secured a credit facility which included fairly long-term low-interest debt just before interest rates went up. And part of that credit facility was something they called an accordion loan, which gives them access to $7.5 million whenever they like, and they haven't accessed that yet. I would suggest all this makes their risk of dilution fairly low. I would also suggest that they could easily make over $20 million this year, which would make them even more undervalued. And why are they so undervalued? There are a few reasons, but the fact that a Google search reveals 2 positive articles about them from a month or so ago, and one more recent negative one which demonstrates a clear misunderstanding of their earnings reports, may have something to do with it.